All right. So we are good. All right. So welcome to another episode. I have the great pleasure of speaking to Caleb West, who is a contact that I've met at a networking event over the last 6 months of being in Edmonton. So Caleb, why don't you introduce yourself so that way our audience will know who you are?
Sure. So my name is Caleb West. I run a company called Seed Group Canada. We primarily focus just on multifamily investments in Edmonton and in Illinois down in the States. We've been doing it for about 3 years. I have a general contracting background, mainly actually working for property owners in apartment buildings, strip malls, shopping malls, stuff like that. And so it was a really good, easy transition for me to get out of the contracting role full time and dive into multifamily ownership.
Oh, that's awesome. Okay. So now you mentioned that you do Canadian and US. So can you elaborate, like what percentages is in Canada, what percentages in the US, and what services specifically do you provide?
Sure. So right now we're a little bit more in the States than we are in Canada as far as the unit count goes. We really saw the big increase in the American market is simply with the mortgage rules and restrictions that we face in Canada. Even though you are buying commercial properties, there's still a lot of things you have to hop through. So down in the States, we do the same kind of partnerships that we do in Canada. So we either do a limited partnership agreement or we do a a unanimous shareholders agreement with our partners. So we act as the operational partner, taking care of the property management, tenanting, property management, all that fun stuff. And then our operational team does everything. We include some of those services that are kind of standard across the board for when you would think of joint venturing or partnering with an advisor or a professional. And then we also have our financial partners actually sit on the board as what we call a CFO, a Chief Financial Officer. So they get to see all the daily transactions. They get those updates once a month. We have a back-end login from our software program, so all of our investors can log in and see what's going on anytime they want.
Okay. So do you only deal with, seasoned investors or somebody who has a lot of money?
It depends. So everything that we do has to be in compliance with what's called the Canadian Securities Exchange and the Alberta Securities Commission. So what that means is that we can only work with people who are, to us, friends, family, and close business associates, okay, or accredited investors. So we could do something called an offering memorandum, which we would never do. In our personal experience, it just doesn't have enough return on investment to make it happen. Okay. And so we do work with sometimes first-timers, but a lot of the times as people who have started in residential, really seen the restrictions from the government, and then are just not wanting to have things dictated to them by the government. So they go into business and commercial, and there's much less government regulation or change on the mortgages and stuff like that we face.
Okay. So now I hear a lot of noise there. Where are you right now, Caleb?
You know what? Right now, I apologize for the noise. I'm trying to move around. I actually do some management over at West Edmonton Mall for a group of investors that have some stores here. So currently I'm trying to find the best place in West Edmonton Mall that's the quietest, and it seems sometimes that it's just not quiet no matter where I go in this lovely mall.
Yeah. And you know what? West Edmonton Mall, so for those of our listeners and watchers who don't know where West Edmonton Mall is, it's sort of like the most touristy place in Edmonton to go to. Yeah. And so my understanding is that people from, like, say, China or Japan will come specifically to West Edmonton Mall just to sightsee and shop. Like, the entire trip is just to go to West Edmonton Mall.
Yeah, that's absolutely correct. So where we've seen something that's kind of unique in West Edmonton Mall is that there's been a lot of Japanese and Chinese stores that have opened up exclusively. So the marketing, the branding, the signage is not in English at all. Yeah. There's just such a rush over here from the Asia that it's quite neat to see.
Yeah. Okay. So tell me, so while we're just on that topic about the West Edmonton Mall, what is it that you're doing with the West Edmonton Mall or with your clients at that mall?
Sure. So one of the things that we do with C Group is we also do business consulting, advisory, and marketing. So part of that means making sure that people are going to be able to get exposed the right way without having to pay massive fees to big organizations. Okay. And for a lot of it is some of them are mom and pop stores, some of them are new franchise owners as well. It really depends on kind of what their focus is and what they want. We try to work with them kind of in a way to help them out on the cash flow side with their business, and then hopefully be able to build some relationship with them to earn some trust and earn some reputation that we take them into a real estate deal as well.
Yeah. So you actually bring up like a very good point here, that regardless of, if you're in real estate or whatever business you're in, it's actually good to have several streams of income coming in so that you're not just focusing on one specialty, but having several income streams coming in so that your business is a lot more profitable.
Absolutely.
So that's great.
Yep, absolutely.
Okay. So why don't we go back and talk about the real estate stuff? Because the majority of our listeners will be interested in that. And then if we have time, then let's bring up that business side of your business, because I run my own business as well. And so I'd love to get your input on a lot of your thought processes as well.
Sure.
And and then a lot of our real estate investors who are listening, at some point they're going to either open up their own real estate business, right? Or venture into some other business and then just sort of have real estate as a side portfolio, right?
Absolutely.
So I think that there's a lot of synergies there.
Yeah, for sure.
Yeah. Okay, so let's say I am an accredited investor and I come to you and I say, okay, Caleb, I'm an accredited investor and I would like to invest with your company, with your firm.
Sure.
Tell me what that process would be and what my return would be like. So like, let's say what my experience would be like with dealing with you and your company.
Sure. And that's a really good question. There's a lot of different rules and processes that we have to be compliant with when we're working, even when we're working with accredited investors. And part of that is our onboarding program. And so we actually like to get to know the people that we're working with. We like to be able to show the three biggest things that we think build trust, and that's commitment, consistency, and demonstrated capabilities. And so we really worry about the conservative nature of a deal. We're not very optimistic. We like to be able to look at things very deeply with a lot of scrutiny. So we have our lawyers that are involved in the deal, like everybody's are. We have a financial advisor. We have different people who are much more successful than I am, who I've been able to gain some relationship with, who actually look over the deal as well and make sure that I haven't forgotten anything or maybe overlooked anything. And so for us, the process in that dynamic is, the first one is, we just listen to what your goals are and what kind of returns you want to get, what your hopes are in a couple of years, and seeing if this is a fit. And it's not for everybody. We know that we're not going to work with everybody. The desire of the returns, the magnitude of what they want to see in the capacities to get the money that they want is just something that we can't always hit. So we're not going to, fluff it up and try to work with everybody. It's a very fluid process from start to finish. The onboarding program takes about 3 weeks, depending on the type of the project that's going to be involved. If it's a Canadian project, there is some guarantees that have to happen on the mortgage documents. If it's down in the States with us, we don't have any. So as a general partnership with the team that we have down there, we actually cover 100% of the mortgage liability, and the partners who are coming in with their finances don't have to guarantee a thing.
Okay, so if you had to give maybe one or two sentences to describe what an accredited investor is.
Sure. So these are things that you can find out online on the government websites. I try to stay away from giving exact definitions, but because they do seem to vary. So it's a certain amount of income per year and a personal net worth statement. So wherever you look, you can always go to the Canadian government website and you can find out exactly what they are in the Canadian securities exchanges, which is really important that you do as an investor, because it's up to you, not your partner, not your banker, not your lawyer. It's 100% your responsibility to see if you are an accredited investor. And if you're not, and people are approaching you and you're working with people who you don't have a relationship with, you really need to check things out and see what your liability exposure is, because you can get a large hand slap from the Canadian Securities Exchange, and you just don't want that in your past as well, right? So you want to be able to work within that. But as far as two sentences go, there's a certain amount of income that you have to have in your home or for your person, and there's a certain amount of personal net worth that you have to have as well to be classified as an accredited investor.
Yeah. And so just some information for our listeners. A lot of times when you are approaching a company or like an investment, they will actually provide in all of the documentation that they give you, a lot of that information about, okay, you have to be an accredited investor.
Absolutely.
Right. So it's not like you're just counting on somebody verbally telling you, or that you have to go and check it. Like in the documents, they'll actually tell you need to meet these criteria. Otherwise you can't even do business with us. Right?
Yeah, exactly. And so what we initiated last year, I guess this year, for all of our deals going forward, is that we actually have a sign off that's done by every single partner's lawyer and their accountant. So on top of everything that the Canadian Securities Exchange expects of us, we also have another document that is your accountant, your financial advisor, your lawyer all sign off and say, yeah, these three, points are met. And then that's submitted to us. And then from that point, we say, great, now we can do business together. So it's just to make sure that everyone's compliant.
Yeah. So that's an extra step that I haven't had to deal with in the past when I've done investments. Right. So that's a difference. So now, okay. So if I'm coming in as an accredited investor and I want to do business with you guys, would we be investing in a separate property, like a brand new place? Or would I be joining an existing property that's already up and functioning and there's already groups of investors in there already?
Yeah, so we have both options. So part of that works as being able to sell investment shares that we currently own in a property. So that might be something where on the operational side, we might want to sell some of our equity shares to shareholders, or our partners might want to sell some of theirs. Now, it all depends on kind of what the obligations are for the unanimous shareholders documents and the limited partnership documents. We have both. So you can either come to us and go into a new deal where we're working with one or two investors, where we're solely working with you, or you could come in, you could buy an existing deal with us and buy some equity in the building where you don't have to come in and go through the process or spend as much money as the original partners would do with the legal and stuff like that. But you can buy equity points and percentages in existing buildings all over Edmonton and down in Illinois as well.
Okay. All right. Fantastic. So now what is the minimum investment that you are asking from potential clients?
Sure. So on our front, we found that minimum investment is really, it's something where people sometimes want to have a large investment and it scares a lot of people off. And until you build the trust with people, until you demonstrate commitment, consistency, and capability, I don't want to give you more than $5,000. And once you show that, then I'm opening the purse strings and I'll give you 150.
Right. Which is why I'm asking that question. Right?
Yeah. So for us, we don't really have a minimum. We try to work with investors kind of where they're at. The more money that they're putting in, obviously the more serious we're going to take them in that capacity. The more that we're going to, show them the different processes and stuff. Some of them want to know everything. Some of them don't really care. They just want to write a check, get a passive return, and get a check every quarter for a couple grand and just sit in their hands and do nothing. So it all depends. We've had some people who have who've created corporations where they'll put 5 or 10 grand each into a corporation, and then that corporation will come and do business with us. So instead of signing with 20 partners at 10, 15 grand each, we're signing with one partner, one corporation for 250 grand, and the person just goes and raises their own money from their own friends and family who we can't do business with, and then they come and they work with us, or they'll work with another investment group. And so they're making us a completely separate corporation to do that.
Okay. So now that's a slightly different strategy, right? Because
absolutely.
Okay.
Yeah. There's lots of ways to do it. Sometimes people are just coming directly to us. They're saying, hey, I got 10, 15, 20, 40, 50, 65 grand. What can I do? And we show them what they can do, and we start the process. And for us, we know that having money in the bank is the most important way to go and do business, and showing a bank statement to a seller or a vendor is a lot easier to get them to say yes than it is to hypothetically say, I think I have enough money in the bank. I think I can get a mortgage. Let's tie up your building for 45 days and see. No one who knows what they're doing wants to sell you that. So we send bank statements with our offers that show the cash that we need for the closing, as well as an irrevocable letter of credit from a financer.
Okay. All right. So now if an individual wanted to set up their own corporation and then go to their family and friends to raise the funds and then come to you guys to do the investment, do you provide the coaching or the mentoring as to how they would go about approaching their family and friends to raise the capital that's needed to go in there?
Yeah, to a point. Like, obviously everything that we do is going to be compliant with Alberta Securities Commissions, and so everything is documented really well. So we're not legal advisors, we're not financial advisors. We can kind of point them in the right direction of doing so. We can coach them in a capacity that will help them raise the money, but we're by no means attending the meetings with them. And they're raising that capital for their own side with their own friends and family. And so
right.
we need to be very careful with what we're doing with Alberta Securities Commissions. and just making sure that everything that we do is compliant. So for us, we say, here's an opportunity to talk to people. We tell them how we've done it before, what's worked before, what hasn't worked before. And we kind of say, hey, this could work, this might not work.
Yeah.
But a lot of it's going to be if you have demonstrated trust with people and you have commitment and you have consistency and you have capabilities, people will work with you.
Right. Right. Yeah. Because also too, like if they're going to their friends and family to raise the investment, you know, there's a level of risk that the family and friends are taking on as well. Right. And
100%.
So, like, yeah. So that information needs to be conveyed. Right.
Absolutely.
So now if that individual is setting up that corporation or and then bringing in family and friends, do the family and friends also need to meet the criteria of being an accredited investor?
So if they're friends and family and close business associates of the person that they're making a corporation with,
Okay.
no, they do not.
Okay.
So they're not investing with us. They're investing in a corporation with their brother, sister, aunt, uncle. Okay. And then they are then deciding that is as the director of the company, okay. They are then approaching us and saying, hey, Caleb, we want to do business with you. We're a functioning company. We've got a tax number. We've got a business corporation. We've got all the legal structure set up. We want to do business with you. They're allowed to go ahead and do that.
Right. Okay. Okay. So now, so I'm just thinking like on a side note here. So if this person is creating a company, then they would have to either administer it and cover the costs of that or hire somebody to administer all of that. And then there's accounting fees and legal fees and all of that stuff that goes
100%. Yeah. So they're just like any private company that we would go to, whether we, you know, for us, with the partners that we do have, every single corporation is a new corporation owned by corporations owned by our partners. Okay. So we don't have a corporation that's owned individually by let's say me and 10 people. Okay. Everybody who's involved will have a corporation, okay. And those corporations will own shares in a brand new corporation made specifically to buy that asset. Okay. And then that asset then has, let's say, 10 shareholders, and I'm classified as the operational partner. Mm-hmm. They're classified as financial partners, and they put in the money, we put in the time, the effort, and the demonstrated skill set, and we then own a new corporation.
Gotcha. So now, I guess as an investor, the one thing we always look at is, okay, well, how soon will I see my ROI, or how much is my return?
Sure. Yep. So on our front, where we have a minimum benchmark, and our minimum benchmark on our deals, which are very conservatively calculated, they're not 30, 40, 60% ROIs with a bunch of market appreciation and speculation. We use an appreciation of 3%. In the first year that we own the property, we say that property is not going to increase in value in the first year. So if you buy it for $2 million in 2020, in 2021, it's still worth $2 million. It's not worth 3% more. So we use 3%, which matches the rate of inflation, and we'd like to see that number can continue forward. We know that in Edmonton, year over year, it's about a 5% return on investment as far as passive appreciation goes. But we use 3, and we always will use 3. Our minimum benchmarks are about 12 to 15% per year on a very conservative basis. Now, optimistically, those look like 20 to 25, but conservatively, we're saying worst case scenario, we don't have the market increases that we can in Alberta. Obviously, we can increase the rent once per year to pretty much whatever we want, whatever the market can bear. And that's kind of one thing that's nice about Alberta is that we do have recessions, which everybody knows about. But when we can come out of a recession, we always come out the fastest when it comes to rent increases. And so you might have a really couple, like we've had recently, a couple poor years, and all of a sudden we're able to increase our rent from $900 a month to $1,050 a month, right across the board on over 15 assets. And that's a lot of cash that you can increase, but it's because you're not regulated as much as you are in BC or Ontario.
Yeah, I was just going to say, that's actually one of the biggest things that I found out when I moved to Alberta was that rent increase, right? Is that in Toronto, you can only raise it by a percentage every year, and that's regulated, right? You're capped unless you apply for some other way. Whereas in Alberta, after 12 months, you can raise it as much as you want, right? And if the tenant move, right? Yeah,
exactly.
Yeah. So that whole that strategy that you just mentioned, it's a fantastic way for a lot of investors to get a lot of passive income without doing any of the work, right? And so their initial involvement is just to validate the information, the performance, all the documents that you send them. And once they start investing with you, then it's really sit back and wait for the money to come in.
Yeah, and so on our terms, ideally our terms are 10 years. We believe that real estate's a long-term game. It's not a, volume basis. You'll have 500 buildings and be making 1% on a building. We're pretty selective on the partners that we work with. Our terms are 10 years because we believe that in 10 years on a very, again, worst case scenarios in 10 years, if you only average 10% per year for whatever reason between cash flow, market appreciation, and mortgage pay down, that in 10 years, you're going to have 100% return on investment. Mm. So people are happy with that. Now, optimistically, we could say, well, we think it could be 7, right? Or, if we're really optimistic, we could say it's going to be 5 years, you're going to get 20% per year. And in 5 years, you're going to have 100% ROI. Now, that's amazing. Now, people get a lot of, pump up from big national, international real estate forums, and they think that they're going to get these returns of, 20, 30, 40% all day long. And they're going to outwit, outsmart, and outmaneuver people who have been doing this every day for 20 years. Now, you're not, I'm not that good to get you 40% return. And if you do want a 40% ROI on a deal on paper, you can go to Detroit and you can buy a building. And after you walk through all the gangs to go collect the late rent from Unit 72C, you can probably get your 40% ROI, but then it's the input. Now, who's putting the input? That's going to be your operational partner. So your operational partner better be a genius with a security detail if he's going to go get you 40% ROI on these buildings. Now, I'm not saying it's impossible, but if you're looking for that, I'm just not your guy.
Yeah. And you know what, so with the properties that I own, the ones that I manage and I, put in the effort, right? So I'm actively involved in it.
Mm-hmm.
At the most, I'm seeing maybe 25 to 30% year over year on that, right?
Absolutely.
Right. And so the strategy you're talking about is somebody just investing with you and then being very hands off, right?
Exactly.
So very different things here, right?
Yeah, and again, we're talking about the volume of money and the volatility as well. Many people, and we had a lot of partners who got caught up with the mortgage rule changes where December 31st, you were qualified for 500, and then January 1st, 2018, you were then qualified for, say 385. Exactly. Well, you can't refinance. You make more money than you did 3 years ago. Yeah. The plan was to pull the money out, and for us, we were happy. We were walking away with $250,000. Well, that didn't happen because not one of our partners could ever refinance. And in the end, the market was low. Yeah. So if they were selling their homes, they were going to lose a pile of money. Yes. So it didn't make sense. So now we're holding them for another 3 years, and we're looking to sell equity points in those to get cash out because we don't want to wait to get paid another 3 years. Unfortunately.
Right. So then the exit strategy would be to either to extend the contract or the term, or they take a hit, right? But if everything is rosy and the timing makes sense, then they're at the end of their term, then the exit strategy is that they would cash out.
Yeah, exactly. So what we would do is we would either sell the asset and everyone gets their money and then they get their share of the cash. Ideally, what we would do is we'd actually buy our partners out. We want to own real estate and manage it long term. A lot of our partners, they like the idea, but they don't want to own and manage it. And so for us, if we hit our goals, we're able to actually buy our partners out in year 5 or year 7 and give them their 100% return and get them paid out 100%. And they're very happy about that. Yeah. And then we roll them into another deal that's already kind of sitting in the ranks, just waiting for the deal to start.
Right. So now with the return, I guess on an annual basis, are you giving out dividends or are you giving out any sort of payment at all? Or does that money just go back into the property and into the books so that you guys can reinvest it into the property or into the mortgage pay down?
Yeah. So it all depends. So a lot of investors that we work with, they want to see cash every month or every quarter because they're talking retirement, right? They're talking about income supplementation. So for us, where we look at that, we look at it and say, well, if we can get them their cash flow, of say $2,000-3,000 a month, and maybe they're not making a ton of money, then they're going to be able to avoid paying really high taxes. Where we have other partners who are, they're making over $100,000 a year, and they don't need another $40,000 a year cash flow. They're going to get taxed a lot,
30% or higher.
Yeah, they're going to. So for them, they would actually choose to defer their cash flow to the other partner and say, hey, Chuck, well, why don't you take my $30,000 this year? And then they can figure out a tax strategy to kind of overcome that tax hit. Whereas on our side, it all depends. I mean, each partner, some of them might choose to just defer it and say, I don't want any cash. We say, great. Some of them might say, I want cash every month. We say, great. Some of them might say, I want cash every quarter or every 6 months. Great. So we kind of work with our partners and cater to the needs that they want.
Yeah. Yeah. Because actually, if they reinvest it back into the company, you know, and if it's sort of like at that 10% return every year, then you're looking at around like the 7.5 year where you would actually get back all your principal, right? It's that rule of
Yep.
72, right?
Exactly. Yeah. So, and it all depends. And I like that you brought that up, because some people, like, they're not maybe familiar with all these different terminologies. But when you're looking at, you know, the rule of 72, and you're looking at 7 years, for us, we know that if we can guarantee the interest rate, like if I can get a 10-year mortgage rate, I'm going to take it, because that's 10 years of something I can depend on in real estate. And real estate's always, you know, static, right? It's always changing.
Yeah.
So for us, if we can get the 10-year, when we do our pro formas, it actually makes sense to pay all the penalties, to break the mortgage in year 7, to refinance, to buy out every single one of our partners, give them all of their interest back, plus they've got their 70, 80, 90% return on their original principal, and then just simply roll them into another deal. Now, the nice thing about working down the States is that we can actually roll our money, called a 1031 exchange, into another property. And that's what we really like about the American market for people who are looking long term, and they're not looking for high returns right now. They're kind of saying, I'm working, I'm okay with that. I don't need, you know, 80 grand a year. I'm not planning on retiring, so let's just roll it into another deal. So in Canada, we don't have some of these great tax loopholes that we do in the States. And so it all depends what people want. Some people are comfortable down in the States. Some people are not, and they want to stay in Canada. So we can't offer them as high of a return.
Okay.
And we're not going to guarantee that we're going to be able to get the same kind of return that we're going to get in Illinois at, you know, a 9 or 10% cap rate. In Edmonton, we're going to get, you know, between 5 and 7, maybe 8% in a couple years after ownership, if it's really good management and we can increase the rents. But there's a lot of work that goes into that, and so I don't want people thinking that it's just an easy thing to do.
Yeah, no, it's not, right? Yeah.
It's very hard, and you know, running a company for 6 years in the general contracting world, running a building with 15 tenants and keeping you know, people happy, and then having other commercial assets that we're managing in other apartment buildings is a lot. And so we took over a building for the full management just last month, and so for us it was good. We took it over, and we had 5 vacancies. We filled those 5 vacancies in 2 weeks, and we went from making $8,000 a month to making about $14,500 a month, just because of some really good management. And you know, the fact that you actually care about your tenants because they're paying your bills is a lot different than what a property manager, you know, wants to do for you.
Yeah. I'm recently going through that, because when I was in Toronto, I used to manage all of my own properties, right? And so it depends on what side of the fence you're sitting on when it comes to, okay, do you manage your own property or do you hire somebody out to do it, right?
Yeah.
And so with me now physically in another province, I've hired out somebody to do it in Toronto. And it just finding somebody who I trusted enough to communicate with the tenants, right? Because they're my clients. Like, my tenants are my clients because they're paying me every month, basically.
Absolutely. Yeah, they're a client.
Yeah, and finding that right person to deal with them, it took me almost a year to find that one person that I trusted enough and that they would be long-term enough, right? So it's not as simple as just saying, hey, you know what, I'm going to be my own property manager, knock on their door and stuff. Like, if you want to be actively involved and be a good landlord, there's skills and mindsets that go with that.
Yeah, absolutely. And that's one of the things that we do as well in, like, our business consulting advisory side. You know, we show you how to set up a call center so you can get all the calls from your tenants, even if you're remote. You know, is it uncontrollable overflowing water? Yes or no? Is there no heat? Yes or no? And then if it's not those things, you're going to get a hold of them the next day at 9 o'clock, but your phone isn't ringing at 2 a.m. from a tenant who locked their keys out because they have your cell phone number. So we show people how to set things up in a very systematic way, so that even if they do have their own property manager, which sometimes banks require you to have in the commercial asset world, you can actually control all that information, because your tenants are phoning the number that you control. They're not phoning your property manager. So every single tenant complaint, every single tenant concern goes to you, and then you get to decide, how do you want to care for that tenant who...
Oh, Caleb, I think I lost your connection there. Are you okay there?
Who's just, oh, that's person number 75-975. Oh, I might have lost you there for a second.
Nope, I got you. You're back.
Can you hear me now?
Yeah, I can hear you.
Oh, we're back. Okay. So it all depends on what people want to... So it all depends on what people want to be able to have happen, but we're happy to just consult people and kind of give them some advice to go and do it themselves. we've had a couple people who have done that successfully, and we've had a lot of people who have kind of gotten in about halfway through and they're like, no, I don't want to do this. This is a lot of work and I don't want to learn it. So then they just partner with us.
Yeah. So like I love dealing with my tenant clients, right? Because I love that one-on-one. I love that interaction. But I know with a lot of landlords, they want nothing to do with their tenants, right? And so it really depends on that, right?
Yeah, absolutely.
So now you mentioned, I don't know, about 10 minutes ago, that that some of the investors didn't qualify for that same amount of money because of the mortgage rule changes in the last year or 2 years. And I know that in one of your articles, you had mentioned that in the contract, it's good to have a clause about mortgage rule changes.
Absolutely.
Can you give an example of what that mortgage rule clause, like how it might read?
Sure. Yeah. So on all of our deals, we kind of use a standard document, and there's little tiny edits that are specific to each deal because it's not generic. So on ours, sometimes it might say something along the lines of, 90 days prior to mortgage renewal or refinance, there's an investor meeting, and they can't do certain things in those timelines that are going to negatively affect the mortgage qualification. So for us, how do we know how drastic that change would have been for people with the stress test of going from 3% to 5.5% or 6%? Sometimes there's that, as a working partner, you're going to get paid. And for us, that's what happened. We get paid from any of our deals that we started 3 years prior to the mortgage change, because where we had bought them, where we had refinanced them, we renovated them, we were sitting in there with about $170,000 of equity in each unit, and then our partners could not refinance. Now, we made some big bets that we were going to be able to refinance, and unfortunately, with the market changing, banks are banks. We're never going to be in control of them. And so for a mortgage clause, it could be something that the financial partners are obligated to defer the cash flow to the working partner 100%, should they not be able to refinance. Now, what that means is that if there's, let's just say, $1,000 in cash flow from a really good rental property that's just a suited home with 2 rental suites, we're splitting that cash flow. And let's say that there's $500 each. Well, if I can't get paid because there's qualification rules, I suffer. And I am not going to get paid, and the deal is not going to be able to have the return. Now, it all depends on what your relationship is with your investing partner. Some of them might say, no, it's in the contract, we're not going to renegotiate. And some of them might really be empathetic to that and say, you know what, like, yeah, I could imagine that. Like, you're not getting paid. Like, you're barely making enough money to do this. Now, there is the rebuttal of that is, sometimes the working partner didn't put any money in the deal whatsoever. So, they're still making an infinite return, which is true. But you don't want a partner who's unhappy. You don't want a partner who's jaded. You want partners who are transparent, authentic, upfront about things, and they're working together. And if you're going to act as a financial partner, that means that you are the bank. That means that you are 100% liable and responsible for every single penny that needs to be put into that deal, because that's your obligation. So providing that you have a good joint venture contract, you can have your lawyer give you some advice on some different options. Now, I can't speak to those because every lawyer is different. Banks to banks. But for us, we have clauses where there's deferred equity, where they are looking at different options. And so we know 90 days ahead of schedule if they're not going to be able to qualify to pull out the money. And our financial partners are then obligated to come up with the money from somewhere else, because that was the original deal that we made with them. Now, not everyone's going to sign the documents, but if you have capability and commitment and consistency, and your partners trust you, they'll do it.
Okay, gotcha. So that all makes sense. So now, I was reading in one of your other articles that you mentioned the rules 120/66 and then the 150/33 rule.
Yeah.
Can you explain what that is? Okay.
Sure. So it's just a really quick sniff test on a property that anybody can do without having to pester their realtor or a real estate professional. So you take the house that you want to buy. Let's say you think you can buy it for $300,000. You add $120,000 to that price, and you look for a house within 6 blocks that's sold that's sold in the last 6 months. That's been $420,000. If you can't find it, you're going to have a really tough time. And then if you do find it, you say, oh, a house that's like comparable square footage and look and feel to what we think this can be sold for in say 4 months of renovating. And then you just tighten it up and you say, okay, well, at 150. So can you find a house that sold for $450,000 in the last 3 months in 3 blocks of your house? If you can't find it, you have the most expensive house in the neighborhood. Good luck selling it.
Okay. Oh, I see.
I mean, you might, but you're the highest priced house comp.
Okay,
And
so
it's tough to sell.
Okay, so that 120 and the 150, you applied it on a property that was 300. So would you use 120 and 150 even if the house was, say, $1 million? Or is it?
It's so essentially where we base that on is we base it on a little bit of profit, and we base it on a little bit of renovation costs. So going into residential real estate, if you can go in 100% cash, it's always better to do it. If you can't, we're saying you need $120,000 to put a suite in the basement.
Okay.
And if you might be able to sell for 420, but if you bought it for 300, you're not making any money. So that might be a hold property. But if you're trying to buy a house and you're not putting a home suite or a basement suite in it, or a nanny suite or anything like that, and you've got, say, $60,000 for renovations, you've got $30,000 for overhead holdings, mortgage insurance, legal fees, and so like that, you have a potential to make 30 grand in 6 months or 3 months, right?
Okay.
It all depends. And so the 120,000 and the 150,000 is your combined renovation budget and your profit cost or your profit margins potential.
Okay.
Yeah, so you might make it, you might not. It's really risky to do. And flips, although sexy and fun and all over television, are the hardest thing to do for people because it's a short-term gain. You can do it if you've got the cash 100% to do it and you got a good team. But flips are the things that I've seen the most people lose money on because it's a short-term goal and a quick win. And we don't focus on that. We focus on long-term plays and long-term returns.
Yeah.
It's safe, it's boring, it's predictable.
Yeah. It's funny that you mentioned about that flip stuff because about 3 years ago, I looked into that whole flipping strategy and I was like, okay, do I want to do that? And so I teamed up with a really good friend of mine who is a professional flipper. And so we did a 5-part series on how to flip. And it was great because I got firsthand training on how to do a flip from every angle. And at the end of the 5-part series on this program, I'm like, nope, I'm not doing flips. I'll stick to my regular buy and hold it.
It takes a lot of guts to do it. And it's the most publicized thing, right? Like long-term investments are not fun. Like they're not something that you can put into a 30-minute television show on HGTV or something like that. It's like my life is pretty boring and mundane when it comes to repositioning a building. It's like, well, it's going to take 4 months, and what's going to happen? Well, we're going to get some documents signed by some lawyers, and we're going to pay out, $10,000 in legal fees, and we're going to deal with some tenants and do some renovations. But it takes time, and it always does. It always takes more time, and people get really bummed out and bogged down. They try to be really optimistic. I'm very optimistic, and sometimes with scheduling, it really comes to bite me in the butt. Is that I think it's going to take less time because I'm just really optimistic, and then in reality, it takes like 2 or 3 times as long. And then for some people, you're like, yeah, it's okay, it's a long-term deal. Whereas other people are very upset that they want that quick win, and it's just short-term. So we try not to work with partners that are looking just for short-term, fast cash wins, get rich quick. It's not. You're going to have to work, and you're going to have to work at your job and enjoy life, and there's lots of other stuff to do. And then that in 10 years or 5 years, you've got a chunk of cash that you can do something with that, again, you can either take and spend and leave, or you can just reinvest into a deal and just kind of keep rolling from year to year and make 20, 30, 40 grand a year on top of what your salaries are. And it's not a bad life. There's nothing to be ashamed about. People are like, well, Caleb, I only own 2 properties. I was like, you own 2 properties. People don't even own 1, and you own 2. Oh, and you own a private home too, so you own 3 properties. Like that's nothing to be ashamed of. Like that's a big deal. And a lot of people decided that really think need to focus more on living life, as well as real estate, not just doing one thing so hardcore, trying to over leverage and be the next HGTV star flipper, right? It's possible, but I don't know if it's plausible for 99% of the people, unfortunately.
Yeah. Well, the other thing to think about too is when you talk about how many houses you own or how many doors you own, right? The thing to think about too is, okay, well, how many of those do you own 100%, right? Versus how many of them do you own with somebody else, right? Because I love it when somebody says, Hong, I own 50 doors. And I'm like, wow, that's fantastic. Well, how many of those do you own on your own? Right? Because the profit that you get from owning something 100% on your own is very different than having to share that profit with somebody else. Right. And so, because like some of my coaching clients, they're like, Hong, I want 50 doors. And I'm like, okay, well, why do you want 50 doors? Like,
what's the metric? Like, I agree.
Right.
It doesn't make sense, right? It's just kind of like an arbitrary number. Like for us, we might be able to do just as good, and we've done just as good on 10 doors as we've done on 30.
Exactly.
It's
Yeah.
the right deal. So it's, it's not like you have a cap and you say, I want 50. It's like getting married. Do you want to go through 50 marriages, or do you want one really, really good one, right? Like in reality, no one's like, yeah, I want to get married 50 times. They just want one really good marriage, and you just need one really good deal. And for us, we were able to partner with people who really got what our vision was behind what we were doing with Seated when we started 3 years ago. And we've been able to do a lot of deals with the same group. Yeah. And it's been great, and it's been profitable, and it's been purposeful, and it's been philanthropical as well. Yeah. And part of that is because you had one really good partner, and you demonstrated consistency, and you demonstrated commitment, and you demonstrated capability. Mm-hmm. And it's a long play. You can't always be the rock star, and it's not as easy as these big forums and big real estate groups tell you it is. It's not. Mm-hmm. It's the hardest thing you're going to do, other than marriage.
I love that. I've actually never heard that analogy before, that real estate. That's hilarious.
Well, it's like for most people that we work with, I think we have one person who we work with as a partner who is not married, but everybody else is married. So everybody else gets it, and they're just like, all right, no, it's true. It's, it's cheaper to stay married than it is to split. And I was like, well, yeah, you're going to have to split up your doors and everything else, and there's 50 million things that could happen, but it doesn't matter how many doors you have. It matters how many great doors you have, just like your tenants. It doesn't matter if you fill it. Like we could have filled our buildings on this reposition that we got last month. We could have filled them in a day. We had so many applicants, but then they become problems and they trash the place. And you're like, oh, well, we got it done really quick. It's like, that's great. But if they're not good tenants, they're going to cost you so much money long-term that the short-term gain of filling a building, like it on that building, it took 16 months to buy it, renovate it, reposition it. And we didn't make any money in 16 months, not a penny. Mm-hmm. But now we're going to be killing it at about an 8% cap rate. So it's worth it, but you got to have the right partners who can kind of stick to the vision.
Right. And they're not going to be freaking out on you because they haven't seen any money come back. Right?
No, exactly. Right. And it's part of that due diligence as the financial investor, or as the working partner, or as the operational partner. But more so, I believe, as a financial partner, it is your due diligence. It's your responsibility. It's not your lawyers. It's not your accountants. It's not your operational partner. It's you. It's your money. No one else is liable for it but you. So do the math, get involved as much as you want. Only work with people that you trust and have demonstrated capabilities, and not just people who have, great marketing videos and a bunch of emotional, lights and sirens and introductions. Like, work with people who know what they're doing and have done it before and have actual relationship with their investors and are going to put the time in. But also don't waste people's time. If you're not interested, just be upfront and intentional. And we've had people who have come in and pose as an accredited investor, and then we find out that they're just there for information. We're like, oh, we don't really want to work with you anymore, but like, we'll help you out as we can, but like, I'm not going to trust you. And whereas if they would have just been upfront and said, hey, I'm just here to learn, could you tell me how we maybe could pull some equity out of our house? Yeah, it takes 30 seconds. It's upfront, it's intentional, it's respectful of my time. And I'm courteous to be able to do that. I'm glad to do it. But, it's a two-way street, right? It's a relationship. So
Right. Yeah, and it's funny because I have a lot of individuals who reach out to me and say, hey, Hong, you know what? I just want an hour of your time to ask you all these questions, right? And I'm more than happy to do it. Whereas if somebody comes to me and says, hey, Hong, I want to hire you for coaching, but then they're really not there yet, right? And they come on that premise of wanting to hire me. It's two very different conversations, right? And you're right, like building that trust is so important at the beginning, because if I go through the conversations and I realized that all they really wanted was just some information, which I'm more than happy to give, right? It sets the tone for future conversations with them where I'm not going to trust them. And I don't want them to be a client anyways at that point, right?
Yeah, yeah, exactly. Exactly.
All right. So let me put you on the hot seat, Caleb. I'm going to
Sure.
ask you a couple of questions and just fire away. Okay.
Right
What's
on.
your favorite color?
Blue.
Mine too. Awesome.
Perfect. That's why we get along.
All right. Now, if you could travel anywhere, money and time was not an issue, where would it be?
Probably Italy and France.
That's two places.
This, yeah, two places. It's Europe. I'll say Europe.
You're awesome.
Right?
All right. Now, if you could have one superpower, what would it be?
Flying. 100%. You got to fly.
Yeah, flying is a good one. Okay. Okay. I'm going to ask you. Okay, for me, it's teleportation.
Ah. Also, it's kind of like flying, just quicker.
Yeah, I'm all about efficiency, so I just want to
Yeah.
be somewhere and that's it.
Just get there. Yeah, makes sense.
All right. What is the one thing you hate?
Besides the Calgary Flames,
Okay, never would have thought of that one. Okay.
yeah, the Calgary Flames. One thing that I hate, hate's a pretty strong word.
Yeah.
I hate bad service. Like when I'm gonna go and spend my hard-earned money on a meal and it's just not great, I
Okay.
hate it. And I usually let people know. I say, hey, you know what? Like your service kind of sucks. Maybe your day's off, but your service sucks today.
Oh, that's hilarious. Okay. Awesome. So, oh, Caleb, I lost you again. Can you come back? Caleb, are you there? I can't see you and I cannot hear you. Caleb, are you there? Hello? Caleb?
Oh,
Was that me or was that you?
that was probably me. My Wi-Fi isn't the best here, so.
All right, so we are still going. Okay, so
Yeah.
that was the end of it.
Perfect. Well, good timing then. So, yeah, no, it was great. Really good questions, and hopefully this adds value to some people that are out there asking about real estate. And
Yeah, no,
we'll
okay, so I'm going to stop this. Okay,
sure.
so